Good morning, students. I hope you are all fine. Now, I'm going to discuss extra questions for chapter 14 regarding audit of the sales and collection cycle. The first question, which of the following is an account that is not, be careful, is not affected by the sales and collection cycles? Of course, all of them are correct, apart from number D, which is accounts payable. Actually, we normally use this account when we consider acquisition and payment cycle. The second one, what critical event must take place before goods can be shipped in order to assure payment can be reasonably expected? Of course, none of them also is correct. The most appropriate answer is credit approval, which should be mentioned in the sales order. Of course, in addition to, if you remember, authorization for shipment should also be written in the sales order. Number 3, a document sent to each customer to show his beginning receivable, AR balance I mean, and the amount, and date of each sale, cash payment received, any debit or credit memo issued, and of course the ending balance. The most appropriate answer is the monthly statement, which contains all the previous information, of course. Number 4, an item, a document or a record is a list prepared when cash is received by someone who has no responsibility to record sales, AR or cash. In addition, he has no access to the accounting record. Of course, the most appropriate answer is number A, pre-listing of cash receipts. None of the others is correct. Number 5, for a firm that practices good internal controls regarding sales and collection cycle, the function which indicates credit approval should be recorded on which document? Definitely number A is correct in the sales order. Number 6, tracing bills of lading to sales invoices provides evidence that realize that tracing bills of lading to sales invoice, we want to make sure that all shipped goods afterwards we send our customers invoices. So the most appropriate answer is shipment to customer were invoiced. So you want to make sure that all shipments were invoiced. Even you can relate bill of lading as a document of shipment to shipping, and consequently invoices to send invoices to our customer, you can relate it to were invoiced. Number 7, When designing audit procedures, tracing of source documents to the customer's subsidiary ledger, sometimes we call it master file, as you all know, and subsequently to the general ledger, realize that the general ledger is a control account over subsidiary ledger. To satisfy which assertion, it means, appeal, the management appeal, that everything is correct and fine, right? So the most important answer is number C, completance. It means no transactions were omitted. Let's go to true or false questions. Number 1, the overall objective in the audit of the sales and collection cycle to evaluate whether the account balances affected by the cycle, they are fairly presented, of course in accordance with GAAP or IFRS. Actually, this is true. Number 2, a sales invoice is a document that usually indicates credit approval. Of course not, false, because such information is normally written in the sales order, right? Number 3, tests of the presentation and also disclosure related audit objective are not generally done as a part of completion of the audit. This is false, because this is normally done. Number 4, confirmation is not a common TOB, test of balance, for the accuracy of the receivable. This is false, because actually for confirmation is the most suitable and common evidence to confirm or to perform test of balances, right? For both, actually, for accounts receivable and as well as accounts payable, right? Number 5, tests of completance. It means nothing is omitted of the real transactions. Balance related audit objective are for the purpose to evaluate the allowance for doubtful accounts. Of course not. This is false, because the audit objective to be reached is realizable value balance audit objective, not completance objective, right? Number 6, for most audits, a proper cash receipts cutoff. Cutoff, it means to separate between fiscal years. I mean, don't shift transaction to next year, 2022, or premature accelerate transaction which may occur next year to this year. So you have to separate between accounting periods, right? So cutoff, sometimes we call it also timely, you know, is less important than either sales or sales return and allowances cutoff, since cash only affects the balance sheet, of course, not earning, not the income statement. Actually, this is true, because cash balance should be presented end of the year on the balance sheet. Number 7, vouching tests are for omitted transactions, where tracing tests are for non-existent transactions. This is false, of course, because you should reverse it. Since tracing is to achieve completeness objective, which means no omitted transactions, whereas vouching to achieve existence, which means to search for any non-existent transactions. Number 8, fraud is more prevalent in large business than small ones, and also for non-for-profit organization. Actually, this is wrong, because fraud may be occurred in all types of organizations. Best of luck for all of you, and I have finished the lecture.